From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, bond market volatility looking for a narrative. Another COVID outbreak raising questions about the outlook, with investors looking ahead to the Fed's next meeting. We begin with the big issue, pushing ahead to Chair Powell.
The market's really going to be focused on next week.
What is the Fed going to do next week?
You know, the how, the what, and the when.
I think you're going to hear still a very dovish message.
All attention's going to be on the language.
I'm in the camp that inflation is not going to be transitory, that the Fed should ease its foot slowly off the accelerator.
The Fed is going to need to stop playing chicken with inflation.
I think you'll hear something different from the Fed.
I'm afraid no matter what they do, you're going to see market volatility.
They are going to try to condition the market to a very gradual QE reduction, and I think the market will accept that to begin with, and then reality is going to sink in that they should go faster.
Clearly, if you ignore inflation here, as the Fed seems to be doing, it could be a lot harder to rip off the Band-Aid later. And low rates right now should not confuse people. The Fed is in control of the curve.
I understand why the market is doing what it's doing. My concern is what the Fed doing good for the economy.
Let's get you ready for the weekend. This is going to be the fastest 25 minutes of your life. Morgan Stanley's Lisa Shalett joins us now. Greg Peters of PGIM and Ashok Bhatia of Neuberger Berman. Let's start with that Mohammed question, Lisa, just quickly. Is what the Fed's doing good for the economy? Is it?
Look, it depends on what your time horizon is. I think that the Fed has made it clear that they have a new framework, and that new framework is fundamentally about maximum employment. And so if you believe in that as a social good, as some people do over the intermediate term for the economy, then holding rates at these levels may make some sense until we understand the pace at which the labor market is going to cure. If, on the other hand, you believe that financial market stability actually has an implication for the economy, which we do, then I think it's very hard for the Fed to justify using emergency levels of QE, which, again, just to remind people, is 2 to 3 times the pace that we saw in several of the QE episodes during the Great Financial Crisis, to persist at those levels of QE when clearly the emergency has passed, really threatens financial stability.
Ashok, what's your take?
I think the Fed's done a good job, and I don't think the Fed is going to be panicking, or getting too worked up about what the unwind looks like. From the Fed's perspective, and the big change in this COVID period has been fiscal and monetary policy, pointing in the same direction towards above trend growth. But from the Fed's perspective, we're getting jobs coming back. There's some issues with labor supply that the Fed's going to keep having to work through. And inflation, from the Fed's perspective, is finally getting back above the 2% target. And, the Fed, I think, Fed and the market and us have, good expectations that, there is a big element of this inflation that's transitory. And the end state of this COVID environment is likely to be, for the next couple of years, above trend growth and inflation hitting its target. And from the Fed's perspective, that's kind of, what they've been shooting for the years since the financial crisis. And I very much agree with Lisa's point that this is a lot of balance sheet purchases. But, compared to some previous episodes, the Fed's got experience with navigating an unwind, and, certainly expect that the reduction, which will be a big issue, or at least an ongoing issue in 2022, is not going to be market disruptive.
Greg Peters, your reaction?
Well, the Fed's doing exactly what they're supposed to be doing. I think the narrative around financial stability is a red herring. I think they have to talk about it, but they have really no control over it. And look, this has been a shock to the system in a way that we haven't seen before, and they responded in kind. And we've come out of this from an economic standpoint really much stronger than I think anticipated. And so I think it's been the absolute correct response. The real question on the table, however, is how do you get out of it?
Yep.
right? And so I'm sure we'll talk later about peak growth, peak inflation, perhaps. And then you have a scenario that the Fed is possibly tightening into that, whether it's through reducing purchases or actually raising rates.
Well, let's do that right now, Greg. What do you think is going to happen?
Well, I think, they're going to lay out a path of taper. I expect that to be, if not a Jackson Hole, then immediately after. And, over the, by the end of this year or early next year, they'll start to do it. And then the question is, when economic activity looks like it's slowing from this peak level, will they continue upon that path? So I actually think they've somewhat painted themselves into a corner here, because it's a much more difficult narrative to say, we have this flexible inflation targeting program now. Inflation is coming down, yet we're raising rates into that. I think it's a really tough challenge they have ahead. So the easy part has been the past 12 months. The hard part is the next.
Lisa, do you think the bond market is capturing this conversation appropriately, given the range we've seen this week alone?
Look, that's hard to say, right? It's hard to fight the tape, and it's hard to fight the markets. Our perspective is that the bond market has way, overbought, and the levels that we're seeing on the 10-year don't reflect economic reality at all. But they probably do, to this discussion, reflect a lot of the game theory about what exactly the Fed is going to say, both in the upcoming FOMC meeting and coming out of Jackson Hole about their pace of tapering. And, I think, as has been alluded to, this idea that the Fed may be out of sync with the economy right now, where economic indicators, corporate profit earnings, growth indicators may be peaking. Fed accommodation, the peak of Fed accommodation is still in front of us. And that does set up, some potential for dissonance next year.
This idea, though, that we won't get any resolution to these supply side issues before the end of the year, late Q4, at the very earliest, you'll see signs of it maybe in September. Ashok, what's the argument to move before then?
I don't think there's an argument to move on rates. I think the argument to move on tapering, and we do think they are going to move on that, is that, if you're the Fed, you're forward looking, and, we look at the Fed's projections and effectively conclude that if the US job market is creating 400,000 jobs a month, that's sufficient to start, really closing the output gap and things like that over the next couple of years. And when the output gap's closed, the Fed probably shouldn't want and won't want to be purchasing the same amount. So the Fed needs to start tapering in advance of, that sort of crossover point on the output gap. 400,000 jobs, plus or minus, that's not a very high target for the Fed or for the economy to hit in this environment. So I think the argument boils down to, if you want to skate to where the puck is, the Fed needs to start tapering because the trends are pointed in that direction for, end of 2022.
Greg, is there an argument to say that we've seen the peak in yields? I keep asking this question. I've had a yes from Francis Donald of Manulife. I've had a yes from HSBC, Steve Major. I've had a yes from elsewhere as well, from your shop, from Robert Tiff of PGIM. Do you agree?
Yes, of course. So we thought yields peaked in the first quarter of this year. It seemed rather heroic at the time. So a great call by Robert and the PGIM team for sure. And we think we're in this range of, from 1% to 160. And our target for year end was, 120. And, things have moved in a more violent matter than we initially thought. But I think the direction of travel is spot on. And the bond market, like it or not, is sussing out this peak growth, peak inflation story. And I think you have to pay attention to it.
Lisa Shalett, this is where I sense there might be some daylight between you and Greg Peters.
No, absolutely. I mean, our perspective is, we have to differentiate between, rates of change, sure. But we knew a year ago that the rate of change in growth and probably for corporate profits and many other metrics were really going to roll over. So I don't really think that's what's going on here. I think that what's going on here is we've got unbelievable amounts of excess liquidity holding rates down. Once we start tapering and the economy moves up, there's just no way you can justify -1% real rates on the 10-year in an environment where, GDP growth, even at half of what we're doing right now, would be 5%. That's just a level that I just don't think the economy is going to price rates once the distortive behavior of the Fed gets out of the way.
Ashok, final word.
Yeah, I'm on Team Lisa on this one. I think we're going to see higher rates. I think the market's trading this peak narrative growth right now, but the next narrative we're going to focus on is, as Lisa said, what comes next. And what comes next is going to be multiple years of above trend growth driven by tail impacts of fiscal spending. And so the market, 3 months from now, 4 months from now, this fall is going to be looking at an outlook that's north of 2% GDP for the US, north of 1% GDP, we think, for Europe, with inflation in the US at 2% and not going a lot higher, but above those levels. And that will then be the narrative of durable above trend growth. And we think that supports something like a 2% 10-year note. It's not getting out of hand, but it's also not 120.
We'll continue this conversation. Ashok, Bhatia, Lisa Shalett, alongside Greg Peters. Coming up, the auction block, the high yield market showing no signs of slowing down. Carnival with a 4% coupon on 7-year debt. That conversation's next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg, a real yield. It's time now to head to the auction block, where we begin with things over in Europe. Primary issuance slowing to a crawl this week, with just 9.5 billion euros pricing market-wide, marking the quietest week so far this year. In the US, 10 billion high-grade sales also falling well short of estimates. The standout deal coming from VMware, raising 6 billion in its 5-part offering. And finally, in high yield, Carnival returning to the market, pricing new bonds yielding a 4% coupon, down from 11.5% last year at the height of the crisis. Lisa Shalett back with us. Greg Peters, Ashok, Bhatia. Greg, I want to start with you. Carnival, a 4% coupon after 11.5% last year. After all the talk about what's going on with this market, the fears over growth over the past week or so, what does that tell you?
Yeah, I mean, it tells you, man, what a different 12 months make. But there's a bazillion reasons to be positive on credit. The challenge ultimately, though, is one evaluation, right? So we're in this really credit repair phase coming out of the lockdowns at all. That's really quite positive for corporate credit writ large. The challenge ultimately, though, is are you getting compensated for the liquidity and default risk on the come, and that's where it gets a little more challenging. And to Lisa's point, I think that's where the excess liquidity is going. I don't think it's being forced into the U.S. Treasury market as much as it's being placed into the corporate credit market. And I think that's a accelerator of where spreads are going and where they've been.
Lisa, your take.
Look, I think I would agree with all of that. The problem that I have for our clients is, there's just not much, spread left. And so the problem is, since our call is that, we think underlying rates do move up, there's just no cushion, if you will, to preserve capital. And so, do I think we have default risk? No. Do I think that balance sheets are healthy and cash flows are great? Absolutely. Do I think my clients are going to get paid their coupon? Yeah. But do I think that they face underlying rate risk because spreads are so tight? Yes. And so that's the tough conversation we're having with folks. If net, after any risk that you have to your capital, what are your total returns? They might be razor thin.
Underlying rate risk, the distinction you're making there, Lisa. Ashok, talk to me about that.
Yeah, it's a great point. I mean, with where credit spreads are, the outlook, we think is for credit spreads to remain at these tight levels, really range bound. You're not going to see a lot of capital appreciation from credit markets based on spreads. But particularly with these levels, some interesting things to look at are moving out of intermediate or longer duration credit into shorter duration credit segments. So for an investment grade investor, it could be moving out of investment grade to shorter BB plus maturities. For a non-investment grade investor, it's moving out of non-investment grade high yield bonds to loans or CLOs or some of those types of things, where you're effectively taking less duration, getting similar, in some cases above income levels, and effectively saying that the growth environment and corporate balance sheet environments strong enough to take that incremental credit risk. And that's generally our investment posture.
Greg, let's build on that. Shorten up duration, take a little bit more risk outside of high yield per se, and go over to loans. What would your take be?
Yeah, look, I think it's important. I mean, you need to bifurcate the risk, and you can't conflate interest rate risk with credit risk. And so, you need to separate those two things. As we can hedge out quite easily the duration risk and just monetize the spread risk. And so I think that's how you should think about it. So if you're worried about duration risk in a spread risk portfolio, then you can have more of a floating rate type of fund or bond or loan. So I do take somewhat acceptance to the fact of putting those two things together, because you're supposed to separate them out. But at the same time, we do see value in CLOs. Loans is an area that have, I think, outperformed our expectations. I think the best place to be in credit right now is this crossover divide, this BB, where we'll see unprecedented rising star activity, and the BBB part of the market that's continuing to see this balance sheet repair. So I think there's lots of relative value opportunities in credit that we like a lot, but the large beta game is over. It's all about relative value.
Greg, when you talked about a golden era of credit, though, and we revisit that topic often whenever you and I get to catch up, is that the segment of credit quality that really captures that story for you, BBBs to BBs?
It does, and historically, that's kind of been the best place to be over time. But yeah, I think that is an area that you went on both sides of the aisle, so to speak, as you have these BB companies who were hit during the COVID crisis that are repairing and getting back to investment grade, so you benefit from that as an investor. And then you still have these BBB companies that arguably are over-levered, but they don't want to fall to high yield, so they will work really hard to maintain their rating and reward bondholders. So I think that continues to be the sweet spot, and quite frankly, is normally the sweet spot in the credit markets.
Ashok, just a final word from you. Do you agree with that? Because some people might be surprised that that story hasn't largely already played out. What would your response be?
I would just emphasize that comment I think Greg made about the upgrade, the rising star activity being, pretty extreme in this cycle. I mean, we see, maybe 20% of the highest quality segments of the high yield market could end up being investment grade when all is said and done. So there's a lot of positive fundamental credit tailwinds in this environment. So I don't think it's played out. I think it's going to play out, though. It's not going to be an immediate, you're going to capture this improvement and tighter spreads from being upgraded, necessarily in the next 1 month or 3 months. But for a longer, horizon, there's still some alpha or spread tightening on the table there.
Final word, Lisa?
I don't know if I've got the final word on this particular issue, but what I would say is, look, we are using credit, but we're using it very, very, very selectively on a security, focusing on picking securities, not owning beta.
We'll continue this conversation. Lisa Shalett alongside Ashok, Bhatia and Greg Peters. Still ahead, the final spread, the week ahead, featuring a Fed rate decision and Chairman Powell news conference. That's next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, US home sales kicking off the week on Monday. Consumer confidence on Tuesday. Then it's the main event on Wednesday. We get a Fed rate decision and Chairman Powell news conference. US GDP coming up on Thursday and rounding out the week with US personal income and spending on Friday. Final comment now from Lisa Shalett, Greg Peters and Ashok, Bhatia. Guys, just going into Chairman Powell this Wednesday, Lisa, have you got an outstanding question that you think will get answered this coming week?
Look, I think he's going to have to use the word taper in his comments. I think he's going to stick to his view that inflation is transitory. I think he's going to get a lot of push on that. But fundamentally, I think he's going to have to start signaling a timetable for tapering of QE. I do think that the shape of the yield curve is getting his attention.
Greg Peters?
Yeah, so I go back to where I started. I would ask the question and continue to ask the question is how does he reconcile the transitory nature of his inflation forecast versus, tapering and ultimately raising rates? I think that is a challenge that he'll continue to face not only at this press conference, but increasingly so going forward.
Ashok, Bhatia, final words, sir.
Love to hear more on how the Fed is thinking about the practical implementation of flexible average inflation targeting, and I would expect he's still going to be kind of vague on it, but defining that and the Fed's reaction function will continue to be important.
Final word from all of you then. One word answer. Do you go to lunch or do you watch this news conference? Go to lunch or watch this news conference? Which one, Lisa?
I'm going to watch.
You're going to watch, Greg?
Both.
Ashok?
I'll watch, but low expectations for a lot of new developments.
There we go. I think a lot of people are with you. Enjoy the weekend, guys. Good to catch up. Late on the afternoon on Friday. I appreciate it. Thank you very much. From New York City, that does it from us. I'll see you next week. Same time, same place. This was Bloomberg Real Yield. This is Bloomberg.